Well, hello, folks, and welcome. And we are so excited that you've joined us today. We have a fabulous program. And without further ado, we're just going to jump right in. All right. So this is our traditional halftime report, as we've aptly renamed it. It's the 2021 Mid-Year Economic and Investment Outlook. We have a tremendous amount of information that we're going to share with you. The presentation itself should be approximately 45 minutes, and you absolutely want to stay until the very end because that's where all the secret sauce and the nuggets are going to be, where we wrap it up and tie everything together. We definitely encourage questions, and we would like you to type your questions in the Q&A box. You will see the Q&A icon at the bottom of the screen, and you'll be able to type in questions. We will get to the questions at the end of the presentation and try to get to each of your questions as time allows. The disclosures, which is nothing new, we show this every single time. And this is your handsome wealth management advisory team, starting with myself, of course, Sam Dechtman, who is one of the presenters today, and Adam Dechtman, also one of our esteemed wealth advisors. And he is also helping with technical areas as well as research as we're presenting this. So you will hear from myself and Sam. And next item. So the agenda today, Sam is going to cover the agenda items, and then once he is through those areas, then I'm going to come back and wrap things up. But real quickly, there's 6 agenda items. We're going to give you an economic outlook and market update. And I think you'll be pleasantly surprised what you learned today. There's a lot of good things going on, but there's also some areas that we're watching very closely. The second area is inflation. You can't help but hear this almost on a daily basis. What's the real story? What are we doing about planning for this inflation? And is it a concern? There are 5 big investment concerns. We're going to cover those one by one, and Sam, again, will address those individually. There are proposed tax law and retirement changes. We're going to hit the high notes and touch on those as well. And then we're going to wrap it up by giving you investment strategies. Investment strategies, what to do with cash, amongst other things. And then, of course, what are the next steps? So without further ado, Sam, if you want to jump right in.
Perfect. Thank you, Jordan, for that introduction. And so before I jump in, when we discuss the economics in the market, we're going to be talking mostly about where we're at now and where we think we could end up by the end of the year in the future. So we're not going to be spending too much time as to what already happened in the first half of the year. But of course, we will touch on it because it's hard to describe where we're at without a little background. So I guess to begin, despite the surging Delta variant, the economy continues to see a powerful recovery. The July unemployment report showed a robust progress towards full employment, with the unemployment rate falling to 5.4%. The country's GDP after the second quarter is now officially larger than when we started the pandemic. An important note, many of the pundits, many of the economists expected that this moment would not happen until at 2022 at the very earliest or later. So a mere 18-ish months after this was declared a worldwide pandemic, the United States GDP is officially larger than where we began. While nearly 10 million Americans remain unemployed, last week's jobs report showed the number of job openings has now eclipsed the number of unemployed Americans by a remarkable 1.3 million. The last time this occurred, in early 2020, the employment rate was at a 50-year low. So much has been written about the mutating virus and how its more contagious Delta variant has spurred a surge in cases, hospitalizations, and fatalities. However, the economy is also mutating and adapting. These adaptations are reducing the ability of the pandemic's waves to slow the economy. They are also boosting productivity and profits. Between the fourth quarter of 2019 and the second quarter of 2020, real GDP per worker rose by 5.5% or 3.6 on an annualized basis, which is almost 3 times the growth rate in the first 20 years of the century. I want to say that again just one more time in slightly different words. The United States workers' productivity has increased at the highest rate since the beginning of the century. So there's a lot of very positive things. However, the main headwinds as we see it at the moment are strained supply chains, rising inflation, and the distortion in the labor market. So let's actually touch on that last point first. So what we're looking at right now is a graph of job openings going back from the year 2000 to April of this year. And what I want us to take a look at, of course, is if we look at where it was in April, it was a little over 9 million in terms of available jobs. And so another thing to point out is this is also the highest reading that we've seen here on record going back again since the beginning of the century. So who's hiring? Hotels, airlines, restaurants, construction, manufacturing, warehousing, and of course, in all ways, Amazon. It's mostly service-oriented businesses that were really harmed, that were really stricken by the pandemic and the closing of their particular industries. So they're trying to find work, and they have all of these job openings, which is a record. But the issue is that employers are having difficulty filling the jobs. So what we're looking at now is the percentage of firms with one or more jobs unable to fill. So as we can see, the main number here on the right-hand side is 48%. So what that means is roughly 1 out of every 2 firms is having difficulty filling one or more jobs. So why are they having this difficulty with this record number of job openings? Well, more generous unemployment benefits, continued virus fears, new childcare responsibilities, older Americans leaving the workforce, and reduced immigration of all restrained labor supply. While many job openings are also not a good match for the skills of the unemployed workers. So it's possible that these structural mismatches in the labor market will mean the economy reaches full employment at a higher unemployment rate than the previous expansions would suggest. So to just reorient ourselves, full employment is somewhere in the neighborhood of 4 to 5-ish%. Going into February 2020, we had the unemployment rate in the 3.5-ish%, 3.4%. So we think that when it comes to full employment, maybe we'll be somewhere in the neighborhood of 4.5 when it's all said and done right now to the structural mismatch. So this is definitely one of the headwinds. If all these employers that are looking for jobs can't get people back to work, that is definitely something we're keeping an eye on and could definitely cause issues down the road. So how are companies doing? What we're looking at right now is a graph of the S&P 500 earnings per share going back from 1998 and then projecting out what it could potentially be for 2021, 2022, and 2023. So in more normal language, what we're looking at is profitability of companies. And so the blue bars here on the right-hand side show us where we could potentially be from a profitability standpoint for the 500 largest companies here in the United States. So as you can see, they expect that profits will continue to, increase not only this year, but in the years ahead. And so just statistic for you. What happened in the second quarter of the S&P 500 earnings is you had 86% of firms beating estimates. Analysts now estimate that the S&P 500 operating earnings for 2021 will be 24% higher than the record set in 2019. So I want to say that again. The profits of the S&P 500 are expected to be 24% higher than where they were at the end of 2019. So this is extraordinary how fast these companies have become so resilient and continue to increase their productivity and profitability. So when we see the stock market continue to do well and break records every now and again, it's because the fundamentals of a lot of these businesses are there. And we're going to touch on what breaking records really means for you on a go-forward basis here in just a minute. But by and large, wanted to demonstrate that corporations, as we feel, are doing very well, and as I mentioned earlier, are also becoming much better at adapting to the changing environment. So how is the consumer doing? What we're looking at is a graph which shows the percentage of income that the US consumer used to service debt. So what this is saying is what percentage of an individual's income is required to pay down debt, required to pay down the mortgage, required to pay down credit card bills, required to pay student loans, etc. So what we can see here as we move from left to right is from the 1980s increasing all the way up to 2008, we saw that Americans became more indebted as a relation to their income. But shortly after 2008, a very sudden drop, we saw many folks start to deleverage their own personal situation. And as we saw going into the pandemic, we were at what was at that time a 40-year low. And then with the ability of the government to provide stimulus, a lot of folks used those checks to help pay down debt. So credit card debt at this point last year was actually at some of its lowest in a very long period of time. So the US consumer is now using less of their income to pay debt, which is a very positive sign for us as we look forward. And the reason why it's positive is because roughly 2/3 of the United States GDP is predicated on consumer spending. So if consumers are using less of their money to pay down debt, that it means that they have more of an ability to go out and go on that vacation that they had to cancel last year, that they're going to go to a Rockies game before the end of the year, or Broncos maybe as we approach the fall. So the US consumer, we think, is doing very well from a fundamental standpoint. And then just to kind of put the two pieces together in terms of where we're thinking in terms of the US consumer as well as businesses, what we're looking at here is the leading economic index. Now, this is a multitude of factors and essentially some main points that I want to illustrate to us. And in these thick red columns are previous recessions. So what's important to note is there has never been a recession when the leading economic index is still increasing. And if we look here on the far right-hand corner, we can see that a lot of signs are still pointing very positively. Now, that isn't to say that, the future, couldn't look different, but by and large, historically speaking, when the leading economic index is positive, things as far as the economy continue to follow suit. So now we're going to talk about inflation. Inflation's been in the headlines a lot lately, but it's certainly no stranger to financial journalism or the news over time. So I want to actually read you something that was 2 years ago in the New York Times, and I'm quoting this. Federal Reserve officials are increasingly worried that inflation is too low and could leave the central bank with less room to maneuver in an economic downturn. More recently, a Wall Street Journal article presented a sharply different view with a headline that likely touched a raw nerve among investors. Everything screams inflation. So what we have, folks, is over time, we get these headlines, they're very dramatic, and quite often we really need to distill what is true about what's happening and, cut through that noise. But before we kind of talk about where we're at now and where we think it could go, for those folks who need a little reminder, this is what the impact of inflation looks like. Inflation is the cost of goods and services that go up over time. So if we are to look at today, let's say that to cover all of your expenses, groceries, travel, movie theater, etc., costs $50,000. Based on a 3% inflation rate, which is the historical inflation rate over the long term, in 10 years, you will need a little over $67,000 to do all of those same things, to buy that same gallon of milk, to continue to, drive your car the same distance. In 20 years, it's $90,000, and in 30 years, you need $121,363, or increasing just shy of 2.5 times. So what we're trying to say is that inflation over time is something that creeps up slowly on you if you're not paying attention to it. So if we want to be more conservative and have monies in cash, you just need to know that while, it's not lending itself to the volatility of the markets, inflation is chewing away at it, and you are losing your purchasing power. So now let's talk about where we're at with inflation. So I'm not going to read all of these different headlines, but I wanted to just explain that inflation fears throughout the years have always been prevalent, and they've always been there depending on what the views are. So I'm just going to read the last two actually. So in 1983, this was the New York Times. Interest rates will rise as an inevitable consequence of monetary explosion that we've experienced over the past year. How many of you have heard this headline today? In the 1992 article, in 1995, the USA as we know it today will cease to exist. We'll get a taste of both hyperinflation and panic. This was written by 2 PhDs. So I think we all know how life turned out. The United States is still much like we remember it, but how did the market perform during all of these, different periods? So what we're looking at here is a graph which shows us the S&P 500 return since the date of publishing. So we look at what the return was over the 1-year time frame, 3-year, 5-year, and 10-year. So if we just cherry pick the last two items that I said here in 1983 and 1992, over a 10-year period, the S&P 500 did very well, 14.78% per year, and the 1992 was 10.39%. So the point that I'm trying to illustrate here is, and this is something Jordan and Adam and I talk about all the time, when you read things online, when you go onto the TV, we all know this inherently, that these are particular businesses and they're trying to sell you something. So whether it's the TV, they want you to continue to watch and fear sells. So they're going to continue to come out with these headlines. They're going to continue to try to scare you in one way or the other. And the same thing goes when you're reading online, clicking on a particular blog that they will sell to advertisers. So it's our job as fiduciaries, as your financial advisors, to really look at the fundamentals and see where we're at. So where are we at, and what does inflation look like going forward? So what we're looking at here on this graph, and what I want us to pay attention to, is this solid purple line that's going up and down here. And so this is core CPI, or for more, traditional language, just think about this as inflation. So what this is showing us is the month-over-month change. And if we're looking over here on the right-hand side of the graph, we can see what happened at the beginning of 2021. As the economy began to open up and people started demanding more goods and services, we saw a huge spike because it's not as easy to just turn on supply chains. These are supply chains that have been worked and crafted and perfected over years and decades that when turned off, it's very, very hard to get turned back on again. So for a very short period of time, we saw, month over month change be pretty high. And we can see one of the biggest categories here over the months leading up in the year was used cars. If you wanted to get a used car or a car rental, we can also see as a separate line item, it was extremely expensive. And so encouraging news is that the last month over month change that we saw, particularly from these categories, which we view as transitory, we think lends itself to inflation eventually calming down once we start to see, again, some supply chains work back and forth. Now, we're not saying that inflation won't be higher than where it was going into the pandemic. Leading into the pandemic, the Federal Reserve was trying their very best to get inflation to go over 2%. And since the end of the financial crisis, they were never able to achieve that goal and have it steadily above 2%. So what we're trying to say is we think inflation will be higher than what we experienced from 2008, 2009 to the pandemic, but we do not believe that we are going to have runaway inflation like we saw in the 70s where it was in the double digits. So now we're going to talk about 5 big investing concerns. Of course, inflation was one of them, and we just touched on it. So these are 5 other concerns that we are keeping our eyes on and that folks are telling us. So one is interest rates. And so right now, interest rates are still at their historical lows. The Federal Reserve controls short-term interest rates, and they have it right now from 0 to 0.25%. And so Fed officials are likely to begin scaling back their easy money policies around the end of this year or the middle of next year if the economic recovery continues, which we believe it will. So the first step will likely be paring back the monthly purchases of $80 billion of Treasury securities and $40 billion of mortgage securities. They're still debating the exact timing of when this will get started and how long it will be for. Jerome Powell, who's the president of the Fed, said the Fed is still a ways away from raising short-term interest rates, with most Fed officials believe the first increase will come at the end of next year or the end of 2023. So the Federal Reserve has 2 main levers right now that they're going to pull. And so we think they will only raise interest rates after they've stopped the bond buying purchases and if the economy continues to recover. However, this is something that we're definitely keeping an eye on because they are subject to change their opinions, especially if the recovery continues to be as robust as it has. So in summary, we think interest rates will remain low versus historical standards for a period of time, but it would not surprise us that over the next year or 2, we will continue to see them creep up. So it'll be very important to pay attention to that and have portfolios positioned properly for what we think, could be that possibility. The next is U.S. government debt. The government has already passed $5 trillion in emergency spending and is talking about $4.5 trillion more through different acts of legislation. Now, we don't believe the proposed stimulus will pass, but it is likely that at least $1 to $2 trillion more will. And our government debt is now greater than 100% of our GDP, which is the highest level that we've seen since World War II. So where we're at from a debt level standpoint is larger than we've been in a very long period of time and is something that over the long term, we think will need to be addressed. In the near term and more intermediate term, more stimulus to the economy is likely going to provide some short-term tailwinds. We think that it could help, but ultimately the debt will need to be paid, and having that much of it, is definitely something that is concerning. Now, a big benefit to us when we issued all this new debt recently is that it is at historically low interest rates. So the debt burden that the United States has to pay hasn't gone up as astronomically. So, in summary, with the government debt issue, it does continue to increase. It is something that we would like to see the government get under control, but by no means do we view this as a near-term issue or even, quite frankly, an intermediate-term issue. This is really going to be a future problem that future generations are really going to have to deal with, head on. Next, when it comes to market volatility, there's always going to be headlines about why now is a bad time to invest. There's always going to be data that isn't great. That's a natural part of investing. And by no means do we think that this will continue to stop. We're going to talk about here in a second, but there's going to be what we believe, two bills that are passed in some variation or another. We may get an infrastructure bill, we may get a retirement bill, and we may get a tax bill. So those will all present its own volatility. Different geopolitical concerns may present themselves, as well as just traditional investing. So what I'll say to just remind us, because we haven't had one of these in a while, is on average, going back to 1980, the S&P 500 experiences one correction per year. So on average, one time per year, the S&P 500 goes down 10% from a previous peak. And over that exact same time period, the S&P 500 has averaged over 10%. So we haven't yet seen a major correction this year, and it would not surprise us, it would not shock us if it were to come through the second half of the year. But as I've mentioned earlier in the presentation, we feel that there is so much positive momentum going on that we think that it was just a normal part of the market cycle and would really be just a healthy type of correction. So politics is always going to be a natural concern. And as I mentioned, those three huge pieces of legislation that may be coming down the pipeline. And, sadly, I wish I could say things have improved from a rhetoric standpoint since we gave this last presentation, but unfortunately they haven't. So politics is something that we will keep our eyes on, and something that is definitely something we're paying attention to. But it's very important, and we mentioned this before the election, that even if your political party is not in charge or passing their particular agenda, do not invest based on your political beliefs. And we've showed this chart many times, but whether it's a Democrat in the White House, Republican, Democratic Congress, Republican Congress, the S&P 500, the greatest innovators in this country, the people of this country, continue to work hard, continue to innovate, continue to push us forward. So don't try and get too caught up there. And as far as taxes are concerned, this is really going to be something that could present a major, major opportunity for us and for you by the end of the year, or potentially next year, depending on what the different proposals are that come to play. So as far as what we expect to happen, I'll actually just address that here when we get to the next section. So now we're going to be talking about proposed tax law and retirement changes. Now, all of this is extremely fluid, what I'm about to discuss, but these are things that are hot topics or areas that we think could pass in one version or another. So I'll just start from the top. Raising capital gains taxes and applying it retroactively back to April 2021. So you might be asking yourself, can they even do this? Is this even lawful? Is it allowed? And the answer is actually yes. In 1993, President Clinton passed legislation in August and retroactively raised the top ordinary income tax rate from 31% to 39.6%, which you probably remember that number before the huge 2007 Tax Cuts and Jobs Act. Now, while it is possible, we think the chances are extremely, extremely low. Most folks, no matter what side of the political aisle you fall on, feel that changing the rules after the game has started is unjust and not fair because it doesn't apply or doesn't allow folks to properly plan. So we view this as an extremely low chance of happening because it would be incredibly unpopular for them, again, to change this after the fact. In terms of increasing the top marginal tax rate to 39.6%. This is possible. We're not so sure that this is a foregone conclusion at this point. So this is one that we still feel is up in the air. The elimination of the step up in basis and death as a realization event are both still very hotly debated topics. So what happens is when you pass away and you have different retirement assets or different investment assets outside of a retirement account, when that person dies, as it currently stands, when you inherit those monies, you get a step up in basis. Now, they are trying to remove that, but there are a lot of issues with removing it entirely. So the thought process is that there would still be some exclusion amount. Right now, the exclusion amount for an individual is about a little over 11 million, and for a couple, a little over 22 million. And so we think that there will be at least an exclusion amount of $1 million. And the next, death as a realization event. So what this means is that when an individual passes, it's essentially saying that all of their investments are needing to be sold at that point from a tax purpose to create those capital gains that would have to be paid. We think that while this is something that is common in other countries, we think death as a realization event is a lower probability. We think of the two options, elimination of a step up in basis versus death as a realization event, we think the elimination of the increased step up in basis could be something. However, the increased exclusion amount that was put forth in the Tax Cuts and Jobs Act will actually sunset in a few years anyway. So even if there's no changes whatsoever, that exclusion amount will be coming down no matter what. And so lastly, we're looking at moving RMD age back to 75. As it currently stands, the RMD age right now is 72. So there's different proposals being put out there, whether it's going to move back to 75 or whether or not we're going to have a graduated scale, much in the same way like Social Security has for your full retirement age. So this is something that we're keeping an eye on, and of course will allow for other planning opportunities. Now, of course, there's many other retirement changes and tax law changes that we didn't discuss. These are just the high-level topics that we've been keeping our eye on and we think are important to you. So now that we know where we're at, where we think we're going to go, let's discuss on what we should do in terms of investing and what to do with cash. So just to reiterate why we're focusing so much on cash and different strategies related to that, we can see that there is close to a record amount that is still in money market funds, which, while technically invested for our purposes and for your purposes, should be viewed as cash because you are not gaining really anything in a money market fund, and it certainly won't be able to keep up with inflation based on our low interest rates now. And so what we're seeing here on the right-hand side of the screen is where did the money go after some previous highs. So 1 year after the dot-com bubble, so what we had here in 2003, is we saw the majority of money head to different stocks and bonds, and then you can see what happened 1 year after we saw the great financial crisis. So what's the issue with leaving it in cash right now? I've said it a few times, but this will help really illustrate and bring the point home. So if you have $100,000 in the bank right now, the income that should be generated off that is about $80, whereas income needed to beat inflation is a little over $3,700, almost $3,800. So by leaving monies in cash, it is slowly being chewed away at inflation and your purchasing power is decreasing. So getting it to work, even in a conservative fashion, we think is better than just leaving it all sitting in cash, wasting away. So many of you may be concerned about investing due to recent market highs. So this was research performed by a company called Dimensional Fund Advisors. It's founded by University of Chicago economic professors, Nobel laureates, and they are really some of the smartest guys in our industry. So they said, okay, most folks want to wait till after corrections to invest, but is that really the best idea? Intuitively, it sounds like it might make sense, but does it make sense to wait? So what they did is they looked back from 1926 through 2019 of the S&P 500. And what they found is after a new market high over the 1, 3, and 5 year periods, the investment returns were greater then waiting for the market to decline over 10%. And you can see it comes over every different time period. So if you're sitting at home not wanting to necessarily put some of this, cash to work because we've hit new highs, hopefully this gives you comfort, at least from a historical perspective, about what the market has, done previously. So where might make a good sense to be invested? We think dividend growth stocks. So what we're looking at here is a mountain chart, and the light blue area shows us the total portfolio value by reinvesting dividends if we were invested in the S&P 500 from 1980 through the end of 2020. And the darker blue shows us what the portfolio value would have been if we were not reinvesting dividends. I think you can see the huge difference between the two. By reinvesting dividends, your return from 1980 to 2020 over a 40-year span has more than doubled, almost tripled over this particular time frame. And so what we found too historically is that companies that grow their dividends over time, so not just pay them, but grow them over time, have shown to be less volatile than their non-dividend growing counterparts. So this is one area that we have a part of the investment strategy, but one particular focus that we're going to be paying more attention to for the rest of the year and what the year coming might look like. And so another side, little fun fact is from 1930 to 2020, dividends have contributed about 41% of the market's total return. So they do have a huge effect, especially over time when we compound them. So now I'll turn it back over to Jordan to discuss next steps.
All right, Sam, you did a beautiful job. Thank you. And we've gotten some questions, and I promise we'll get to those here in just a moment. So let's talk about next steps. Next steps. There we go. Okay, so Sam talked about fighting inflation, putting your cash to work, and the fact of the matter is you're not going to get very far by leaving money just sitting on the sidelines. There are terrific strategies that you can benefit right away. And we can talk more about that if you'd like to schedule some time over the phone or in person. But this is absolutely a great time to be talking about other ways to employ that cash sitting on the sidelines. The last item Sam just talked about, number 2, is dividend growth strategies. We affectionately refer to this as the secret sauce. With dividend growth strategies, it's not just dividends, but it's dividends plus growth. And what we're talking about, investing in strategies where you are going to be investing in the best companies, not only in the US, but throughout the globe. And these are brand name blue chip type companies that have a history of paying dividends consistently each and every year and raising those dividends every year. And most of those have raised dividends for over 25 years or more. So it is a tremendous opportunity. And why? Because interest rates are so low. Sam also pointed out that the Fed has signaled very clearly that they're going to keep interest rates very low for a very long period of time. So we want to employ those strategies so that can be a great opportunity. Number 3, this could be a whole presentation, and we probably will have a presentation on tax-free investing, but I'd be remiss if I didn't just touch on this very quickly. Another great opportunity that investing in tax-free municipal bonds. Not only could they be free from federal taxes, but it's also possible they can be free from Colorado taxes. So you're able to boost your return by simply paying less tax. And as Sam also pointed out, there is absolutely a high likelihood that tax rates are going up. So let's get ahead of the curve. Let's look at investing opportunities to put those monies to better work for you. And that can be another investment strategy where you're putting cash to work, either in a dividend growth strategy or a tax-free municipal bond. Review beneficiaries. Now, this is sort of off to the side. It's not a talking point per se, but unfortunately, we have seen 17 instances this year alone where beneficiaries were not properly updated because someone made assumptions that it should have been a certain way, where you have a life insurance policy or a bank account or a pension plan, something along those lines, and it wasn't reviewed. I can't emphasize this enough. It's so important, and we are more than happy to help you. This is something that we look at every time we talk and meet and review things. But again, we encourage you to go back and just make sure that gets updated. And lastly, we're here. We're working in our office. We're working very hard and happy to meet with you in person. We can do Zoom meetings, we can do phone calls, but please give us a call, schedule some time. We want to meet with you, we want to help you. And this is a great reminder and a great opportunity to do some planning with a long runway before the end of the year. So I noticed we do have some questions. So if you would type your questions in the Q&A box, that would be terrific. Sam, we did have a question from Reggie, and can you just explain the stepped up basis one more time, please?
Yes, yes. So let's say that while you are living, you have a brokerage account. So it's a non-retirement account. And you bought stock ABC at $5. Now stock ABC is worth $100. So if you were to sell today, you would have to pay the difference or the gain. So the difference between 100 and 5 is 95. So you would pay $95 would be your capital gain. So what happens is, as it currently stands up to the exclusion limit, if you are to pass and that account is to go to an heir, they would then inherit ABC stock for a basis of 100. So your basis while you are alive is 5, because that's what you bought it for. But when you die, it steps up. So your basis as the person who's inheriting it is now 100. So should you choose to sell that, whether you received it from mother, father, brother, sister, you're able to sell it in a short amount of time and potentially pay, no capital gains. So the elimination of the step up says, if you leave, in the same example, if you pass away with that stock and your heir inherits it, they will keep the $5 basis. So should they want to sell it in the future, they will have to pay the $95 in capital gains versus the way it is now, where they would pay nothing. So I hope that explained it a little bit more clearly.
Okay, great. Thank you, Sam. And just a reminder once again, we are going to be sending a replay with all slides of this presentation. You should be receiving that sometime next week when our technology support is able to pull that together. So we will send this to you. Our second question here is, should I be worried about another recession? Well, we feel very optimistic. We're cautiously optimistic. We're paranoid, as Andy Grove said. to start, consumer banking data still points to the presence of substantial reserves. And, Sam alluded to that earlier, which in essence is a tremendous tailwind for consumer spending. Consumer spending makes up 68% of our GDP. And as the economy continues to reopen, we think that's going to be even more positive. Now, while the research on post-pandemic behavior highlighted suggests that consumers may be a little cautious, but substantial support from the federal government suggests that the consumers right now are in a really different place. And we're emerging and we're growing from this recession. So in essence, as we continue to rebuild and the economy continues to reopen, we think that there is tremendous support for ongoing growth, not only this year, but looking into next year. Okay, so another question here. This is from Jim. Do you expect that the currency mortgage rental market deferral to be serious enough to create the same type of results in 2008? So actually, we have several other questions about housing. And Sam, do you want to answer that question?
Yeah. So, yeah, Jim, I'm going to talk a little bit more generally about housing, what our thoughts are in regards to that. So, it's no surprise that housing prices have gone up astronomically, not only here in Colorado, but throughout major parts of the United States. And so a reason for that is the U.S. has been underbuilding homes for the past 13 years, and this has finally started to catch up with us. And so what's happening now is we have the millennial generation is now larger than baby boomers, and they are entering their peak home buying years. And with interest rates at historical lows, we are seeing demand be extremely strong for new homes. But on the supply side of things, we have not had many homes be built due to different changing in lending standards and building standards since the great financial crisis. But more recently, if you talk to anyone who's in construction, they cannot find enough laborers to do all the jobs. So labor is really strained. You also have materials that have gone up significantly. For example, the cost of lumber at one point this year was 6 times what it is historically. So the cost to build a home has gone up so much. And so what we're having is not only residential housing have been underdeveloped for a period of time, there's also been many, many apartment buildings that have been underdeveloped over time. And we think that these are things that will take years to really work themselves out, assuming that the economy continues to progress ahead. So ultimately, we do not feel that we are in the same sort of housing bubble as what we had in 2008, and that the prices are really just a dynamic of huge demand and very little ability to continue to build at the level that we need to keep up with it.
Okay, thank you, Sam. All right, it looks like we're going to have time for a couple more questions, and then we're happy to take this offline and meet with you individually. Bruce has a question. What do you see the impact of the infrastructure investment related to businesses being able to hire employees? I can start and Sam can add too. Bruce, we've talked about this. Sam mentioned this earlier. It's a real challenge with regard to hiring. Not only are there more jobs than people to hire at this point, we're not 100% clear on what this infrastructure investment is going to look like. There's so many parts and pieces to this, and we are watching it. So it's hard to say how it's going to impact businesses being able to hire employees. We hope that it's positive and that infrastructure related to roads, bridges, airports, and all other types of construction are going to be a boom to the economy. But there's a lot yet unknown, and it's hard to pinpoint exactly what this infrastructure bill is going to ultimately look like. And we have, do we have any other questions here, Sam, or?
We do, but do we have time to answer?
You know what? I think we're going to just pause on that note. And again, thank you all very kindly for your time. Please call us, email us. We would like to meet with you and happy to help you. If it's been a while since we've talked, please come into the office. Let's talk on the phone. Let's have a Zoom call. And on behalf of myself, Sam, Adam, and our entire team at Dechtman Wealth Management, we thank you and appreciate the trust and the confidence you have placed in us. Have a wonderful day. Thank you so much. Bye-bye.
Thank you.